Alright guys, welcome to this lesson on price action false break, trading the price action bull trap and bear trap. In fact, this is a high probability trading strategy that I personally use to make a lot of money in trend continuation trading. Whether the price action is making uptrend, retracement, downtrend, retracement. And we trade this before the price becomes obvious. That means the price does not make a significant move, and we're trading this when it's still in a retracement mode. And I call this strategy a force strike. Okay, force strike, not this force, guys. It's force. You push, force strike. So in short, we call this FS, bull FS, bear FS, right? And I'm going to share with you guys the formation first. Okay, how do you identify this force strike bar? And then we're going to go into a lot of examples to show you how do you trade this on uptrend, retracement, downtrend, retracement. In fact, I like this strategy a lot, and I personally use this almost every other day, right, to trade the markets. Okay, so let's dive into how this formation works. Okay, so force strike is basically an extension of the three main EXE. Okay, later you understand why is it an extension, because the force strike will end with a bullish or bearish EXE. Okay, if it's a bullish force strike, you end with a bullish EXE. A bearish force strike will end with a bearish EXE. Okay, so in short, we call this a FS. It's a price action fractal that demonstrates a bear and bull trap by itself. Okay, and the occurrence of such price action structure at the common simple moving averages, right, indicates a shakeout of the short-term or swing traders, depending on the time frame that you're using, right? If you use this on the short-term time frame, right, it indicates shakeout of short-term traders. If you're using on the swing trading time frame, it indicates shakeout of swing traders. Shakeout means that if traders are long, the price action basically do a counter direction, right? Counter direction means they probably drop down first before going back up. A counter direction, we call this a shakeout in a sense. Okay, so why do I mean by common simple moving averages? So in the price action manipulation course, we realize that we are using very normal kind of moving averages, right? Like your 20 and your 50 simple moving averages. The thing is that, right, there's no need to be fanciful about the moving averages, because we're not trading the price action when it touch 20 or 50 SMA. Okay, our methodology is very focused on, right, things like bull trap, bear trap, right, false top, false bottom, and hence we are looking at what happens when majority of the retailers out there, when they use all these 20 and 50 SMA, what happened to them, right? Because this 20 and 50 is the common moving averages, and we want to know what outside the rest of the trading community are doing at such moving averages, and we will go in when they get shaken out, unfortunately. Okay, so traders can take on this standalone price action. I call this standalone because it does not need to have a false top or false bottom in this case to trade on bullish FS when there is uptrend retracement test of the 20 or 50 SMA. So you can trade this, right, for example here, right guys, as you can see over here, right, for bullish FS for strike, you can trade it when it is in the uptrend retracement to the 20 or 50 SMA. Okay, so it must be up in a clear uptrend. So you must see that the price is making up higher highs, higher lows, or general upside price movement, right? If you don't know how to judge uptrend, downtrend, go back to the earlier lessons where I cover how do you determine uptrend, downtrend in the lessons. I think it's the same as the market flow lesson. Basically, you want to see that price action is moving higher and then it drops against the general direction. So uptrend retracement means there is a downside price movement, and you want to see, right, that the bullish FS appears. I use the word test. Test means it touch 20 or 50 SMA. And actually, you can also say that if it's very near, it's okay. so almost touching, not much space between the 20 and 50, but almost touching also can understand. So because we are more focused on the structure, but as long as it touch, test, or very near is okay. And the reason why I use 20 or 50 SMA is because you never know whether the price action will touch 20 or 50 until it touch, until it tests. Okay, so you never know. So as long as you have uh, the price action right at the 20 or 50 SMA with a bullish FS, we say that it is executable. Executable means you can trade it. Understand? Okay. So next you have your bearish FS. You can trade it when there is downtrend retracement test of the 20 or 50 SMA. So for the bearish FS, right? For the bearish FS, you can trade it. You can trade it when it is going down and then do a retracement back up, right? So the general direction is a downtrend, right? A downtrend. Downtrend, right? This is the uptrend. Okay, must be a clear downtrend and then there's a retracement, means going up against the general downside price movement, right? And then you are looking at the a bearish FS forming near to the sorry, let me use the to the 20 or 50 SMA as well. Okay, and then you're going to trade, enter this short trade, right? So that you can get in right before the price goes lower, and you can get in for the bullish FS before the price goes up higher. Okay, again, for the bullish and bearish FS, you will not know which SMA will be tested, right, until it tested. Okay, you now know 20 or 50 until it tests. Okay, it's just like I always tell my students, right? The reason why we don't use Fibonacci retracement, because you will never know whether the price action will test the, I think, the 30 over percent, right? 30 plus percent uh, retracement, or the 50%, sorry, 50% retracement, or the 60, I think it's 68%, I think, right? But retracement Fibonacci numbers, right? You never know which one will test, right? Until it tests. So the thing is that we are anticipating what will happen, and then we trade based on the facts, right? What the price action tell us at such levels. Okay. Okay, so the formation is like this, right, guys? Okay, you need to have this thing called the inside bar first. Okay, so take note, guys. Please write down in your course manual. Okay, please write down in your course manual. I only know there is a baby when there is a mother. I only know there is a baby when there is a mother. So you only know there's a baby bar when there is a mother bar, and I put a dash line here is because the color of the bar does not matter. It can be green or red, right? It does not matter. It can be green or red as long as the baby bar is within, equal or within the mother bar range. So it can be like this, no, the baby bar is just at the top here, as long as it's within the mother bar range. Okay, the mother or baby bar can be bullish bar or bearish bar. It can be red or green, bullish bar or bearish bar. The most important thing is that the entire range of the baby bar is within the entire range of the mother bar. It's like the mother is pregnant, right, with another baby, right? Okay. So this is the range of the mother bar, the baby bar. You also count the tail, not just the body. The body. So it's the range, right? Range will be the entire the highest point, whether it's a tail or body of the baby bar. So in the case where, let's say, the tail goes above, or the body is above or below the mother bar, this is not not considered an inside bar. So this inside bar shows a period of indecision. It's a period of indecision in price action terms. So the price action does not know where to go, so it pauses a while. And traders who trade the breakout of this inside bar or the indecision in price action terms, right, they actually will trade when the price goes above or below the mother bar range. However, this is when we are trading bull strike or bear strike, we are looking at a bull trap or a bear trap. So it's like there is a breakout, but there's a forced breakout of the mother bar high or the mother bar low. And we say that inside bar is not used as execution signal, but actually a prelude to the 4 strike bar formation. So hold your horses. Right, I'm going to explain further, right, this 4 strike formation next. All right, so let me just open up everything here so you can see clearly. So basically, right, the 4 strike bar formation, this is the bullish 4 strike, bullish FS. So for bullish FS, right, you will have a bear trap. And a bear trap is bullish, right, because traders who trade the break of the mother bar low, right, they will be trapped when the price goes back up above the mother bar low. And this bear trap to us as price action trader is bullish in nature. So we do bar counting for the formation of the bullish 4 strike. Okay, so this is what happened is that, right, you need to have let's say the mother bar here, doesn't matter, like I should do a slash, doesn't matter the color of the body. The color of the body of the bar does not matter as long as it's, the baby bar is within the mother bar. We call this number 1, number 2, right? Number 1, number 2, right? By number 3, 4, or 5. So let me just draw the lows of the mother bar range here. So basically, let's say the third bar is a doji, the fourth bar is also a doji, and then the fifth bar, you have a bullish pin, for example. So by the third, fourth, or fifth, right, basically you want to see any price bars goes below the mother bar low. It can also be a gap down. As long as price trade below the mother bar low, right? I repeat again, it can be any bars that trade below the mother bar low, right? On the third, fifth, or fourth bar, third, fourth, or fifth bar, or price action just gap down. As long as there's price traded below the mother bar low and the price comes back as one of the 3 bullish EXE, bullish pin, bullish ice cream, or bullish markup bar, we consider this fulfill the bullish FS criteria. So common question student ask is, why is it 5 bars, and how about if the bullish EXE appears on the 6 bar or the 7 bar? So the thing is that, guys, I need to set a standard. I need to set a standard guideline, right, to the price strategy formation. Okay, if not, students may go up to 10 or 20 bars, right? And to me personally, based on my experience trading the strategy, I find that the longer it gets, right, I mean the more bars it has, right, the lower probability it gets. So the best would be to be willing to have the number of bars within 5 or 6 actually. So 6 actually still okay, but 7 or more I find is too many. Okay, so my guideline is 5, but if it happens on the 6th, right, and you don't have other better choices, you can still consider. Understand? Okay. So what's the minimum that this can happen? What's the minimum number of bars that this can happen? Because you always need to have the inside bar, right? You only know there's a mother when there is a baby, right? Okay. Let's say this is the inside bar. The minimum this can, number 1, number 2, the minimum this can happen is, let's say, the bar, let's say this is another pin bar, right? The bar that goes below the mother bar low is also the bar that goes back up as a bullish pin. So the minimum this can happen is 3 bars, understand? Up to 5 bars, understand? So the bullish FS, right, can form like this as well, or the price could have gapped down below the mother bar low. As I mentioned, you need price action to trade below the mother bar low. It can be a gap down as well. It does not need to slowly trade down, but it could gap down as well, right? As long as there's price action below, right, it shows that traders thought that it's going to break down lower and go lower. However, price instead closed back up as a bullish EXE. In this case, is like a markup, a bullish markup bar, right? Goes back into the mother bar range. So take note, guys, when the bullish EXE form, right, it must be still within the mother bar range. That means if you have a bullish EXE, for example, let me draw in blue color. If you have a bullish EXE that forms, and it forms like a, let's say, a markup bar and is above the mother bar high, we say that this is not executable. Okay, the reason why I want to have a guideline, right, in cases where the EXE, when it forms, right, is above the mother bar high, I find that in terms of structuring the trade is very wide. Okay, it's too wide. So I set my guideline. Like I said, actually the rationale is the same. It's just that in this kind of case, right, I find that the structuring of the trade means if I enter here, my entry here, right, my stop loss here, it is too wide. The distance is too wide. Okay, so I would take on, if I'm given two trades, one is the EXE forms within the mother bar range when it closes back into the mother bar range, and one exceed the mother bar range, even though it exceeds mother bar range and it closes lower below the mother bar range, I will consider this too wide as well, because I want the EXE at all times when it forms to be within the mother bar range. Okay, so that's my guide, our guideline. Okay, understand? So if you have an EXE that goes above the mother bar high and trade back down a bit, even though it's within, it closed back within, but it has a tail above the mother bar high, I will not want to take this. To me, it's like a lesser probability kind of trade. Okay, and I would prefer to take on those that fulfill the guideline, because this is based on experience that they are the better ones. Understand? Okay. So the significance is, as I already mentioned, right? It is basically shows the inside bar shows a period indecision that cause a false break of the lows of the mother bar, right? And this the return, right? The rejection of the mother bar low is actually a bear trap, which is bullish to traders. And when this happens at certain uh levels in the market, like the 20 or 50 SMA, it shows that market makers are shaking out traders, right? Shaking out traders probably to collect their stop losses, right? In order to move back up higher. So it gives us confidence that this bear trap, right, is likely to move prices up eventually. Okay, there's a higher probability for the price to go up. Next, we have the bearish FX, right? The bearish FX. So the bearish FX works the same, but it's just the opposite, right? You have instead a break above the mother bar high. So it was a period of indecision, right? Price was indecisive, right? And then it forced break up. However, market maker pushed the price down. So those who trade on the break of the mother bar high would be, we call this bull trap. Okay, and the bull trap is bearish. A bull trap is bearish in nature. Okay, and we will take the short trade when we saw such bull trap happening in the market. Okay, so how do we go about counting the bars? Okay, like I mentioned over here, it's a max cluster of 5 bars, same as the bullish FS structure. So again, you only know there's a mother when there is a baby. So I do a slash because it can be red or green bar. So I tell students that it can also be like this, a doji with a doji. This is also called an inside bar. It may not need a body as well. Okay, the most important is that the range of the baby bar is within the range of the mother bar. We count this number 1, number 2, by number 3, number 4, number 5. So let's say number 3 is something like this, a bullish bar. Okay, and then let's say number 4 is a doji. Okay, let me just draw this nicely. Okay, so by number 5, right, let's say it comes back in as a bearish pin, right? This fulfill the bearish false strike criteria. Okay, so the key is to have any kind of price bar or price formation, right, that goes above the mother bar high. It can also be a gap up. Okay, it may not have to trade nicely continuously above the mother bar high. It could be a bar that gaps up and form any kind of bars, bullish or bearish, as long as it's above the mother bar high and trades back into the mother bar range with one of these 3 bearish EXE that you have learned earlier on, which is the bearish pin bar, bearish ice cream bar, or the markdown bar. Either one of these will do. This will fulfill the bearish false strike criteria. We call this a distribution because this is signs that market makers is luring actually catching traders who buy in and force break them. Okay, with an intention of high probability to push down the prices later on. Okay, so the minimum that this can happen is, right, let's say this is again a mother bar, baby bar formation, inside bar formation, right? We call okay, let me just draw this away. Okay, so the minimum this can happen is on the third bar. Third bar, it can be a doji, right? I'm sorry, can be a bearish pin, which means to say that the bar that goes above the mother bar high is also the bar that closes back down within the mother bar range as a bearish EXE, in this case a bearish pin. Again, it can be a bar that gaps up above the mother bar high. I mentioned any price action that goes above the mother bar high, right? It can be slowly trading up or gap up, does not matter. But as long as it closes back in within the mother bar range, and let's say in this case it closes back into the mother bar range as a bearish markdown bar, it will fulfill the bearish false strike condition. Understand? Okay, so again, questions of, let's say, right, the bearish EXE form, right, and it goes all the way down to the mother bar low. Do we still take this anymore? Again, the answer is no, right? Because to us this is too wide already, right, in terms of structuring the trade. And even if it close above, right, it trades below and close back up within the mother bar range, we take it as something like it's not optimal anymore, because it's like the trade has really moved a lot. Understand? So based on our guideline, right, when the EXE form, it must be still within the mother bar range. Understand? So this is our condition, and I created all these strategy with certain conditions, because over the years, based on experience, these are the ones that gives me very high probability trade outcomes. Okay, so let's go into some understanding and some examples here, right? And then I will go through one by one, right, and let you practice, right, with a lot of examples in this lesson. Okay, so for the bullish false strike, right, you can use them, I mentioned, in uptrend continuation. So uptrend, price going up, trending up in clear trending mode. You can call this higher highs or higher lows, or visually general price movement upwards. Okay, this is how we define uptrend. Okay, this is actually how in the earlier lessons how we define an uptrend. Okay, and then price action, of course, in the uptrend, it has to be above the 50 moving average. Agree? It has to be above the 50 moving average, positive flow, we call it as well. Okay, it can be a bullish FS to be seen at or near the retracement to 20 or 50 SMA. So in this case of Lockheed Martin, right, you can see that the price action is clearly moving up nicely, right, trending higher and higher, right, higher lows, higher lows, higher highs, right, in general upside price movement, right. And another way to look at it is that the moving averages, right, the 20 or 50 SMA is sloping upwards, right, is sloping upwards. And then you want to see that there's some kind of a retracement pattern, right? Uptrend retracement means is a counter trend kind of price movement. And in this case, right, you can see that, right, you can see that this is actually the mother bar. This is the mother bar. I only know there's a mother bar when there's this bar here. You can see my cursor over here, this baby bar over here. I only know there's a mother when there is a baby, right? So the third bar here, right, goes below the mother bar lows, and the fourth bar looks like a pin bar, but it did not close above the mother bar low. It's actually the fifth bar. The fifth bar is a markup bar that forms and closes back within the mother bar range and tests the 20 SMA. So this is a valid bullish FS structure. Eventually, the price eventually went up much higher. In fact, over here, guys, right, it forms another uptrend, mini uptrend retracement, right? Mother bar, baby bar, and the third bar. The third bar goes below the mother bar low and also close as a bullish pin bar. And if you look back at the chart, right, the price action eventually goes much higher. I think way above the 400 price price, right? During that time. Okay. So this is the bearish false strike downtrend continuation example. Again, you want to see that price action is in clear downside trending mode. So how we define downtrend, guys, is you say that it's lower lows, lower highs, or visually general downside price movement. And then price action has to be below 50 SMA, right? That's how we define a downtrend as well. Or we say that it's in negative flow below the 50 SMA, right? And you want to see the bearish FS at or near the retracement to the 20 or 50 SMA, right? So another way to look for downtrend, right, is also to look at, right, the moving averages, the 20 and 50 SMA sloping downwards, right? Because the price action usually, the moving averages is usually lagging the price. So if the price is going down, the moving averages will be showing a sloping downwards visually. Okay, so in this case of American Airlines, right, you can see that there was a general downside price movement, right, and then there was a retracement, right, there was a retracement, and especially you can see over here, right, there was a retracement. You can see over here, see my cursor, guys. This is the mother bar and this is the baby bar. I only know there is a mother when there is a baby bar. Okay, so let me just draw this out so you can see, right, this line over here, right? So this is number 1, number 2, number 3. So the third bar goes above the mother bar high, right? And then the fourth bar, which is this bar, comes back into the mother bar high and below, which is within the mother bar range, as a bearish markdown, as a bearish markdown bar. And this confirms the bearish false strike example. And you can short within the sweet spot. So the entries, guys, the entries and exit rule when the EXE form is the same, understand? So please go and review the entry and exit, how to enter in the sweet spot of the EXE, right, is already covered in the lesson. Okay, go and review the lesson and you will know exactly how to enter when the EXE form. So if you enter here, right, this is as best as you can get, right, in terms of trading, right, the price movement before it actually goes back down. And this, I believe, if you put the stop loss somewhere here, entry somewhere here, you will easily get your 1:2 in this example. Okay.